In today's video, we're going to look at what does it mean to short a stock. So most traders are very likely familiar with the idea of purchasing a stock, or the idea that as you buy shares of a company, if that price appreciates, well, then you will make money with it as it goes higher. Well, just the inverse can also be done, which is to say you come in and you sell the shares, you borrow them from another trader, sell them on the open market, and then you participate if the price moves lower. Of course, there is the other side of the trade where if you short that and prices move higher, well then, you will lose money just the same. But it does allow you to have complete freedom over which direction you want to participate in a market. So as you consider shorting a stock, one of the first things you may run into is what is the float? So the float is the number of outstanding shares that a company has, and the short float is the number, or again, more effective as expressed by the percentage, but how much of that percentage is short. In the case here of Microsoft, just showing you a name that, these mega caps usually are going to carry very extremely low float, right? Because hedge funds are not focusing their efforts on really shorting Microsoft through the shares. To show you this, and you can get this by going to Yahoo Finance and then moving over to statistics, and then scrolling down through this, you will find again, you see this also here as the short percentage of the float at 0.68. These are all very low values. And what you want to look for really depends on what you are trying to accomplish. The way that I enjoy doing it the most, and the most memorable that I may ever have, was the short squeeze in Tesla. And this does a great job of showing you the type of movement that can occur when funds are caught on the wrong side of a short sale. So that through a lot of this movement, Tesla was one of the more polarized stocks, right? You have a very strong fan base, but at the same time you had a lot of fund managers that were actively working on shorting the stock. Well, it's that type of movement that can see acceleration to more than double the price. And why is that? Well, because you're going to have the group of traders that are just always buying, right? The long-only crowd, and that of course drives a certain amount of inflows to the market. But then when those large funds that have been short start taking so much heat that they have to cover their position, that also generates the purchase of the shares. And when combined with the buying that's already there, is what will drive these radically exaggerated moves. So Tesla was a huge example of a short squeeze. You also have the meme stocks, right? You'll remember when Wall Street Bets tried to take a hold of GameStop, and they did a pretty good job, right? Squeezing this thing into its lifetime high of 344. This has nothing to do with the valuation of the company and everything to do with large positions that were established on the short side. And then when that starts to get too hot to take, the covering drives the radical, exaggerated moves. I could go on with this to give you more examples like natural gas. You guys will remember there was a video that will likely live in infamy from now on of optionsellers.com, I think since dissolved, right? Because they were selling naked calls on natural gas. And, I know how trading can be. I'm not here to call anyone out or anything like that, but we're all here to learn from others' mistakes. And I believe it may have been this move right in here, right? Because you can think about the idea of, okay, whatever, call this resistance. We can call it a little bit of, an area that need to be cleared, but look at how it gaps, right? That's really what causes this pain, is you've got all your short positions established. Everything's looking just fine as that premium decays and the product trades sideways, but then you have a catalyst. Then you have a spark. You have something that catches all of those shorts a little bit off guard. And then between the natural movement upwards, those shorts having to cover, this blows people out of those types of positions because there is undefined risk in the sale of a call, right? This is also, if you short a stock, the stock can only go to zero, right? There's great support on that side. If you're buying it, that's one way of saying that if you buy a stock, the risk actually is defined. Now that risk can be very large, right? But on the flip side, if you sell something, it can go, in theory, infinitely higher. And that's why people will sit there and think, okay, maybe I can take it and I still want to maintain this short. But eventually your broker will take you out of that. And those forced orders, because when that happens, they don't care about getting you the best price, right? They're going to do those as market orders and get you out. And that type of selling begets more selling, causes these radical movements. And these are some of the most notorious, can you call it that, or the most memorable short squeezes that I have seen, and really helps to explain it. So that's part of what can happen in that. And then going just a little bit further to say again, how might you use this information? Well, highshortinterest.com is one website that maintains a list of these float values. Now, what we usually ascribe, and of course this is a little bit of a moving target and you can adjust the variable, but about 20% is usually considered high short interest. You'll notice that here in this list, they begin listing them when you exceed 20%. So all of these names have high short interest, but there's, as with everything, there's two sides to it, and there will be times where the funds that are shorting all of these are correct. So remember, you're not wanting to buy these names looking for a short covering rally just because there is a high short float. You want to look for a high short float in a name that is getting ready to rally. So you can either filter through this list, scanning through the individual tickers and trying to find those patterns, or you can use something like these simpler scanners, right? The daily pop candidate will scan for stocks that have high short interest, which are also near 52-week highs, right? High short interest can indicate a greater chance for a short squeeze to launch the price higher. So this is one scan that you can go through to give you these kinds of candidates to filter down into the names that have the high short interest, but also exhibit decent patterns. And then you can take it one step further by looking at those same lists of stocks, but then refined to also include a squeeze. So you've got high short interest in a pattern that looks generally favorable and then also has a squeeze behind it. These are the kinds of names that if you can catch a catalyst, be it an upgrade, maybe it be some type of material news, whatever it is, just like you saw in natural gas, if you can get something that gives you that gap, catches shorts off guard, then you can really run, and ideally that is where you are positioned on the long side. So I hope that helps in understanding what goes on during a short squeeze and a few ways you can try to participate in it. You guys have a great rest of your trading day, and I'll see you at the next video.
Without simpler trading, I could not have financial independence.
This is one of the best investments I ever made in my life.
It's helping me find consistency.
It's one of the things that won me